Welcome to the debate. Let's not mince words today. The numbers we are looking at from late January are frankly terrifying.
Yeah, massacre is probably the right word.
Right. If you are watching the on-chain metrics, you know exactly what we're referring to. In a span of just 48 hours, Bitcoin's hash rate, so the total computing power securing the network, crashed by 40%. We lost 475 exahashes per second. To visualize that for a second, imagine 1.3 million industrial mining machines just simultaneously going dark. It is the single largest contraction in computing power we have seen since the China ban of 2021.
And honestly, I think calling it a contraction is almost too polite. We're looking at a convergence of forces, what I've been calling the triple threat, that I really don't think the broader market has fully priced in yet. You have the post-halving economics finally breaking the miners' backs. You have the sudden violent pivot toward artificial intelligence by the major infrastructure providers. And then you have Winter Storm Fern exposing just how physically fragile the network has become in North America.
It is a perfect storm, I'll grant you that. It's ugly out there right now. But the central question we need to answer today is whether this massive miner exodus is a sign of terminal decline, a structural failure of the industry, or if it is exactly what it looks like to me, which is a classic textbook capitulation signal that has historically preceded every major bull run.
And I'll be arguing that viewing this through those historical lenses is dangerous. The landscape has fundamentally changed. The exodus to AI and the influence of the new ETFs create structural risks that historical cycles just cannot predict.
Well, let's get right into it then. I want to start by laying out the bullish case, specifically why this looks like a cyclical bottom rather than the end of the world. When we talk about capitulation, we aren't talking about a vibe, right? We aren't talking about market sentiment. We are talking about a highly quantifiable event where it basically becomes more expensive to mine a Bitcoin than to just buy one on the open market. And that forces miners to shut down. The most reliable metric for this is the hash ribbon indicator.
Right, which essentially tracks the momentum of mining power coming online or going offline.
Exactly. It compares the 30-day and 60-day moving averages of the global hash rate. When the short-term average crosses below the long-term average, it signals that miners are actively unplugging machines. And that signal has been flashing capitulation since November 29, 2025. That is over 2.5 months of sustained distress.
Which, I mean, is an eternity in crypto time. Usually these flushes happen over a few weeks. This is a slow bleed.
It is a long time, I completely agree, but look at how the protocol reacts. We have seen 6 consecutive negative difficulty adjustments. For those who maybe don't follow the deep mechanics closely, the network automatically adjusts how hard it is to find a block based on how many miners are currently running. It does this roughly every 2 weeks. If miners leave, the difficulty drops to make it easier for the survivors. On February 9th, the difficulty dropped by 11% in a single adjustment. That is the largest drop since the 2021 ban.
Meaning the network is lowering the bar just to keep the lights on.
It's self-correcting. It's lowering the bar to restore profitability for the efficient operators. This specific setup, massive miner distress followed by a massive difficulty reset, is exactly what we saw in late 2018 when we bottomed at $3,200, and again in late 2022 at the $15,000 bottom. In both cases, the supposed death of the mining industry was actually the birth of the massive recovery. The weak hands fold, difficulty drops, margins expand for the strong hands who stayed online, and the price finds a floor. It is literally the cycle of life in this ecosystem.
Look, I understand the historical parallel. It's a compelling chart, and if we were living in a vacuum, I might even agree with you. But I'm going to push back hard on the idea that 2026 is comparable to 2018 or 2022. In those previous cycles, miners unplugged, wiped the dust off their machines, waited for the difficulty to drop, and then plugged back in. The hardware just sat there, dormant, waiting for profitability to return. That is not what is happening now. We are witnessing a permanent migration of infrastructure.
You're referring to the retrofitting of the data centers?
I'm referring to the fundamental economic incentives. Look at the reality on the ground right now. Tech giants, Amazon, Microsoft, Google are knocking on the doors of these massive data centers, They are willing to pay up to 25 times more for that energy capacity than Bitcoin mining can generate. You cannot compete with that spread. We aren't just seeing weak miners shut down to wait for a better day. We are seeing major players exit the game entirely because the opportunity cost of mining Bitcoin is simply too high. Look at Bitfarms, one of the largest publicly traded miners in the world. They literally announced plans to exit Bitcoin mining completely by 2027 to focus on high-performance computing and AI.
A strategic pivot by one company doesn't negate the protocol's incentives, though. Bitfarms is chasing quarterly earnings for their shareholders, sure, but that doesn't mean mining itself isn't viable.
It's not just one company, it's a sector-wide realization that the energy is fundamentally worth more when sold to AI companies to train language models than when used to hash SHA-256 to secure Bitcoin. This isn't a cycle cleaning out the weak. It represents a permanent loss of infrastructure to a superior economic competitor. And to finance this pivot, what are they doing? They are dumping their Bitcoin reserves on the open market. This creates a ceiling on the price recovery that absolutely did not exist in previous cycles.
I think you're conflating the business model of specific publicly traded companies with the overall health of the Bitcoin network. But let's dig into that economic pressure, because that really is the root of the purge we're seeing. You mentioned the revenue disparity.
Yeah, the math is just brutal right now. We have to be realistic about what the halving actually did in 2024. Rewards were cut in half, from 6.25 to 3.125 Bitcoin per block. That was manageable when the price was pushing toward that $126,000 peak in October 2025. Everyone felt rich, revenue was high, but since then, we've crashed to under 70,000. Do the math. Revenue for the entire industry collapsed from $45 million a day down to $28 million a day in late January.
It's a severe contraction, no doubt. But that's the nature of the beast. We've seen revenue drawdowns of 50% or more before.
It's more than severe. It's prohibitive. Look at hash price. This is the metric that basically tells you how much money a miner makes for a specific amount of computational work. It dropped from $55 per petahash last summer to around $35 today. If you go out and buy a brand new top-of-the-line ASIC miner right now, say the latest AMP miner, your return on investment is approximately 1,000 days.
Nearly 3 years.
3 years. 3 years just to break even. And by the way, that assumes the difficulty doesn't go up and the price doesn't go down. Who invests in an asset class with a 3-year break-even point when the underlying asset is down 50% from its all-time high? This completely kills the investment incentive for new entrants. The capital expenditures tap has been firmly turned off.
I'm not denying the pain. In fact, my entire argument is that the pain is the point. That financial pressure is the exact mechanism of a market bottom. You mentioned they are dumping reserves. Well, data shows miner reserves are at their lowest level since 2010. They have been selling about 100 Bitcoin a day, which is roughly $7 million in sell pressure every single day.
Which is a constant, grinding weight on the price. It suppresses any rally we try to have.
It is, but it's finite. That is the key word here, finite. They are flushing their treasuries to survive, or as you said, to pivot to AI. But once those reserves are gone, that sell-side pressure completely evaporates. We are watching the capitulation in real time. When you have an ROI of 1,000 days, nobody buys machines. When nobody buys machines, the difficulty adjusts downward, as we saw with that massive 11% drop. That eventually makes the remaining machines more profitable. It's a harsh Darwinian process, but it works. The market is absorbing that 7 million a day. Once the weak hands, or the pivoting hands, are empty, the supply shock hits.
That assumes the pivoting hands stop mattering once they sell their coins. But my concern is about what happens to the physical security of the network when that energy infrastructure leaves. This brings us back to the centralization risk and the AI cannibalization. You seem to view the AI shift as just capital efficiency. Like, oh, they're just reallocating assets, it's fine. I view it as a systemic security threat.
I think threat is way too strong a word.
Look at Riot Platforms. They sold 1,800 Bitcoin in December to raise $161 million. Yes, they are reallocating 600 megawatts at their Corsicana site to AI. Marathon Now, Mara, is buying Ixion to get into European AI. But this actually creates a more robust, diversified energy infrastructure for these companies. Bitcoin doesn't need all the energy in the world to be secure. It just needs enough. And even after this 40% drop, the hash rate is massive compared to where we were just a few years ago. We are still hundreds of exahashes higher than in 2023.
Is it secure, though, or is it just massive but incredibly fragile? We really need to talk about Winter Storm Fern. Late January 2026, this storm hits, Texas freezes, and we see a 40% drop in the global hash rate instantly. Foundry USA, the largest mining pool in the world, lost 60% of its power overnight.
Weather events happen. The network kept producing blocks.
Barely. Block time slowed to 12 minutes. The network slowed down significantly. This highlights a critical vulnerability, the centralization of mining in the United States, and specifically in Texas. After the China ban, everyone cheered that mining moved to North America. Freedom mining, they called it. But we traded regulatory freedom for physical fragility. The Texas grid, ERCOT, is literally becoming a single point of failure for the global Bitcoin network.
That is a fair critique of geographical concentration, I'll admit. But that is a temporary inefficiency. Miners are mobile. If Texas proves to be too risky or too unstable, they pack up and move. That's the beauty of the protocol. It doesn't have a headquarters. It routes around damage.
Are they mobile? That's my entire point about AI. The AI infrastructure is taking all the reliable, high-tier power capacity. They need 99.99% uptime. You can't train a massive language model if the power cuts out for 3 days during a winter storm. Bitcoin miners, who act as demand response tools for the grid, shutting off when power demand is high, are being pushed to the extreme margins. If AI takes the stable infrastructure because they can pay 25 times more for it, Bitcoin is left with the unstable remnants. We are left with a network that is more susceptible to weather, more susceptible to grid instability, and therefore fundamentally less reliable.
I would actually argue the exact opposite. Bitcoin's ability to act as a load balancer, shutting down during a storm like ferning to keep the lights on for homes and hospitals, is a feature, not a bug. It integrates Bitcoin into the energy grid in a way that AI simply cannot. AI servers can't just turn off instantly without losing millions of dollars of computational work. Bitcoin can. That flexibility is its competitive advantage in the energy market. It eats the stranded, waste energy that AI can't touch because AI requires that perfect uptime.
Net flexibility is great for the grid. Sure, the grid operators love it. But it's terrible for Bitcoin's security budget if the hash rate keeps fluctuating wildly because the miners are the first ones to get curtailed every time the wind blows too hard or gets too cold.
But let's look at the market structure itself. You're arguing that the fundamentals are broken, but I'm looking at the auto-correction of the network. As hash rate leaves, whether it's going to AI or just shutting down due to bankruptcy, the difficulty drops. It becomes cheaper to mine. This is a closed loop that guarantees survival. The protocol frankly doesn't care if the hash rate is 400 exahash or 800 exahash, as long as blocks are produced every 10 minutes on average.
The protocol doesn't care, but the market price absolutely does. And this is where I really think history might not repeat. We have a new variable in 2026 that we didn't have in 2018 or 2022, the ETFs.
Institutional adoption. That was supposed to be the holy grail of this space. And in many ways, it has been.
It was supposed to be. But be careful what you wish for. Look at the flows. Since November 1st, 2025, U.S. ETFs have been net sellers. We have seen $6.8 billion in outflows. When you combine the ETFs, corporate treasuries like MicroStrategy, and state reserves, roughly 1/6 of all Bitcoin is now held by entities that behave very differently than your average retail hodler.
They behave rationally. They rebalance their portfolios based on macro conditions.
They behave with heavy correlation to traditional finance. That's the problem. In previous cycles, the hodlers of last resort were ideologues, libertarians, tech enthusiasts. They didn't sell when the S&P 500 dipped. They didn't sell when the Fed moved interest rates. Now, a huge chunk of the supply is trapped in vehicles that are highly sensitive to quarterly earnings reports and macro headwinds.
If the AI narrative continues to suck capital out of the crypto ecosystem, these ETFs could continue to bleed. The auto-correction of mining difficulty doesn't fix a lack of buyer demand. You can lower the difficulty all you want, but if BlackRock's clients are selling, the price goes down.
I accept the macro uncertainty. We can't predict what the Fed or the global economy will do next month. But the on-chain data, specifically metrics like the Pew multiple, is totally objective. It strips away the narrative and looks at the math.
Break that down for us. What is the Pew multiple actually telling us right now?
The Pool multiple looks at daily miner revenue relative to the one-year moving average. It essentially asks, are miners making way less money today than they usually do? It's a ratio. And right now, it is in the deep value zone, well below 0.5. It clearly signals that miners are under extreme financial stress. And every single time this metric has hit these levels, in 2012, 2015, 2018, 2022, it marked a generational buying opportunity.
Every single time works perfectly until it doesn't. Correlation is not causality. Just because the hash ribbons or the Pew multiple flashed before previous bottoms doesn't guarantee the same result when the buyer landscape has structurally changed.
But don't you see the mechanics of it? The fact that ETFs are selling and miners are capitulating is the bottom. You need sellers to run out of ammo to form a base. If ETFs have sold $6.8 billion and the price is still hovering near 60 to 70,000, who is buying? The conviction holders. We are actively transferring coins from weak hands, nervous ETF retail investors, and bankrupt miners to strong hands. That is exactly how a floor is built. You are looking at the massive selling and seeing weakness. I am looking at the market's absorption of that selling and seeing incredible strength.
Or we are catching a falling knife. If the price drops to 55,000, which some models suggest is the true cost basis floor for the remaining efficient miners, those ETF outflows could rapidly accelerate. My worry is that the AI pivot isn't just a miner infrastructure story. It's a broader capital story. Investors are looking at the massive growth in tech and AI, and they are rotating out of digital gold to chase those returns. That is a demand shock that no mining difficulty adjustment can fix.
I completely disagree with the premise that it's a zero-sum game between the two. The world can have both AI innovation and sound digital money. And actually, the capitulation of these miners clarifies the market. We are shaking out the excess leverage. The miners who remain after the winter storm fern damage, after the post-halving margin squeeze, will be the most efficient operators in the world. Their margins will expand dramatically as difficulty stays low.
Assuming the price holds, if we dip below $60,000 significantly, even the highly efficient miners start bleeding cash. Then you have a potential death spiral, where they have to sell more of their remaining coins just to cover basic operating costs, which drives the price down even further.
And that fear you're articulating right now, that is exactly when the rebound happens. The uncertainty about the future of the industry, the worry about AI cannibalization, the anxiety about ETF outflows, that is the exact sentiment that marks a true bottom. You can't have a cyclical bottom without genuine fear. If you weren't scared that the model was broken, it wouldn't be a capitulation. It would just be a Tuesday.
I'm just saying that sometimes the fear is entirely justified. The network is slower, the hash rate is down 40%, and the premium infrastructure is leaving for a different, more profitable industry.
Well, let's wrap this up because I think we've outlined the core gamble here perfectly. It really is two completely different ways of viewing the exact same set of facts.
I agree. It comes down to how you interpret this historic stress test. Is it a forge that burns away the impurities and makes the network stronger, or is it a fundamental crack in the foundation?
From my perspective, I reject the structural fear-mongering. The Bitcoin protocol has survived bans by global superpowers, it has survived wars, and it has survived catastrophic multi-billion-dollar exchange collapses. It will absolutely survive Winter Storm Fern and the corporate AI pivot. The triple threat, the halving, AI, and weather events is simply the catalyst for the necessary capitulation. The indicators, from the hash ribbons to the Pew multiple, are screaming that the purge is nearly complete. For those with patience, the signal is clear.
And I will maintain my caution. Just because the charts look identical to 2018 doesn't mean the world is the same. The buyer landscape is now heavily dominated by ETFs, which are acting as net sellers, and the miner landscape is actively being hollowed out by the AI gold rush. The bottom may be much deeper or last much longer than historical models suggest because these are entirely new structural variables. We might easily dip to 55,000 or lower before we find a real floor.
I think we can both agree that the network is currently undergoing a truly historic stress test.
Absolutely. Whether it bends or breaks is what we'll find out in the next few months.
We highly encourage our listeners to watch the hash rate recovery and those ETF flows closely. That is where the truth of this debate will ultimately play out.
Indeed. Thank you for listening.
See you next time on The Debate.